It was the consensus not so long ago that rates in the UK were going to start to come down gradually in 2024 and well into 2025. But a lot of that seems to have been dispelled with the Bank of England now choosing to hold rates at 5.25%. And it seems Andrew Bailey wants to be a legend in his own lifetime. So in this video, we're going to be discussing how we got here, what we can expect the future to look like, and how you can help to prepare your finances. And as always, we're going to be looking at data. I cannot make bricks without clay. Right, we're going to raise interest rates and make a load of people unemployed. These two things are not connected. This doesn't make any sense. So if we just rewind just a little bit, rates started to go up in order to quell surging inflation as it was on the rise that peaked at about 11%. And this inflation was considerably higher than most other comparable economies. And rates have basically been held at 5.25% since August 2023. And so what you're really starting to see is the decisions start to fracture a little bit. So I think in this instance we had 6 to hold, 2 to increase, 1 to decrease. And to me this is kind of indicative of this divergence that we're starting to see in the economy between what's actually going on in the economy and what a lot of the aggregated data is saying. And I think one of the interesting things about the split decision is that I think it was in December they had 6 in favour for holding and 3 in favour for increasing. So what you're starting to see is this gradual move towards decreasing rates, but they're still kind of outweighed by quite a majority there before we start to see any real movement in the direction of rate cuts. First we'll look at the Bank of England's forecast. Now, one of the things they talk about in the forecast is that they expect inflation to start to dip down towards 2%, kind of towards the end of the year, but then they expect it to tick up again into 2025 and then level out again in 2026, as the graph shows. But one of the things that I think is kind of revealing is that the Governor of the Bank of England, Andrew Bailey, has said, and I'm paraphrasing here, that they're not going to look to cut rates until they're comfortable that inflation is going to be at or below the 2% target for an extended period of time. And I think that's worth noting. And again, it's something we're going to come back to in the conclusion at the end, but it's just a really useful thought to bear in mind as we're going through this video, that they're not just aiming for once it hits 2%, boom, rates are on the way down. No. What they're saying is the rates have to stay below 2% for an extended period of time, which may transpire to be much more difficult, as we're going to discuss. Now, I've not seen the data that they're looking at, but it's kind of hard to imagine that they're not going to be including some of the new Brexit border checks that are going to be coming into effect. And as we talked about in this video here, the Brexit border checks are really one of the main drivers in inflation and why the UK has had not just a higher rate of inflation and higher peak inflation, but why our rate of inflation has stayed consistently higher than other comparable economies. Now, people will say this isn't Brexit related, which is just a tidal wave of bullshit, just sheer nonsense. So just disregard that. There's plenty of evidence to suggest that we've talked about extensively on this channel that Brexit and Brexit related border checks are having an increased impact on prices over the short, medium and longer term. And one thing that I think I've certainly not seen discussed anywhere else is that the Bank of England has a plethora of possible tools when it comes to trying to stimulate the economy. They've got not only interest rates, but they've got quantitative easing, they've got bond buying, they've got all sorts of liquidity tools that they can start to deploy. But actually when it comes to trying to take some steam out of the economy, interest rates are kind of the only tool that they've got. And if you're a hammer, everything looks like a nail. And I think this is really one of the constraints that we're seeing when it comes to monetary policy, is that interest rates are your biggest and your best weapon, but when you start to get to these more difficult or more intricate situations where you are trying to bring down inflation but growth is really sluggish already, it makes the decisions that you have to make much more difficult. So I do have some degree of sympathy, but maybe not the approach I would have taken. So what's driving inflation? We have another video just here where we discussed why the UK has a higher rate of inflation than other comparable economies. But one of the things that we just cannot avoid is that the UK, by virtue of being a net importer, is going to be more vulnerable to external shocks. So we've got the war in Ukraine sent gas prices absolutely soaring through the roof at the wholesale price, which has then filtered down to the domestic prices. We're starting to see some disruption in trade in the Red Sea, which is undoubtedly going to have an upward pressure on prices, which is not going to necessarily lead the Bank of England to cutting rates. And we are still seeing a kind of tightness in the labour market. This means that in order to attract new talent, companies have to offer a bit more money, and then these costs get passed on to their consumers. We also need to be looking at the relative strength or weakness of the pound and how this means that we are potentially importing inflation from abroad. Again, something that we discussed in a bit more detail in the other video. Government policy. Now, in the 1990s, they had this really good idea. It was basically deemed that by separating these two. So you've got the Bank of England looking after monetary policy, interest rates, quantitative easing and so on, and then the government more broadly looks after fiscal policy, taxation, all that sort of thing. And I think this is generally viewed historically as being a good and worthwhile thing to have done, to give the two separate branches of government a tool each in order to manage the economy with. But that does lead us to an interesting conundrum which we face, which is the Bank of England is over here. They're raising interest rates, trying to take some steam out of the economy because they say that the economy is overheated and that's what's causing inflation. But then over here, you've got the government cutting taxes, which in theory is an inflationary pressure to the economy. It's putting more money in people's pockets in order to get people out there spending money, buying new cars, going out for dinner, all of that kind of shit. So we have these two forces which are working in opposite directions. Now, they are not necessarily equal and opposite forces, but they are opposite forces nonetheless. Now, I am extremely cynical. An election is likely coming, so I think it's fair to say that these tax cuts are basically a giveaway to try and get people more on side. I mean, how stupid do they think we are? You'd have to be fucking moronic to not see that. But never mind. I digress. Apologies for that. I've digressed a little bit. Let's get back into it. And I think one other theory that we can talk about is the Phillips curve. And it basically shows this kind of inverse relationship between unemployment and between inflation. Now, this sort of gets to kind of the root of what we're talking about here. Remember earlier when I said if you're the Bank of England and the only tool you've got is a hammer, everything looks like a nail? Well, this is kind of what I'm talking about. So we have the war in Ukraine that sends wholesale gas prices through the roof. So the Bank of England says, right, we're going to raise interest rates and make a load of people unemployed. And you're just like, how are these, like, these two things are not connected. This doesn't make any sense. And it's why I'm generally kind of critical. I think it's also fair to say that there's a growing body of academic evidence which suggests that actually inflation was going to come down anyway, that the UK was the victim of external supply side shocks rather than an overheating in the economy, which seemed to be more the case in the US. And earlier we talked about the monetary transmission mechanism. So when interest rates get changed, these are basically the channels which the change in interest rates will have an effect on the real economy. And there are a few main channels. The first is the interest rate channel, which predominantly does a lot of the heavy lifting. There's the asset price channel, the exchange rate channel, the expectations channel, and the credit channel. All of these working in tandem with one another to try and inflate or deflate the economy. But here's the interesting thing. Now, there's a general theory that the monetary transmission mechanism for each of these channels is kind of different. Credit can move reasonably quickly, but the general consensus is that for the full effect of an interest rate change to filter through to the economy is between 12 and 18 months. So we are getting to that sort of precipice where a lot of the change in interest rates is going to have filtered through to the economy already, and therefore increased changes are going to be even further into the future. Now, why does this matter? I think one of the reasons why it matters the most is that it's a potential signal to the Bank of England that increasing rates even further is going to take more time and is not necessarily going to help them to achieve their 2% goal. So what conclusions can we draw? And I think you get to this quote here from Andrew Bailey, and he's basically saying that it's not just a hit 2% and then rates start to come down, it's hit 2%, maybe a bit below, and it has to stay there consistently. And when you start to look at the core inflation numbers, it kind of seems difficult to see that coming. And so in my view, that puts potentially the larger interest rates cuts that had been initially forecasted kind of 6 months ago, I think it puts them further on the horizon. And Capital Economics have forecast that there's going to be a rate cut probably starting in June this year, and that the base rate will gradually come down to about 3% by the end of 2025. So you're seeing this much more gradual rate cut rather than these big rate cuts that were initially expected. Now, this is a bit more optimistic. Another one of the more pessimistic forecasts comes from Berenberg Bank, and they say, or they're anticipating that rates will fall to 4% by the end of 2025. So again, an even more gradual rate decrease. We should include this really important caveat, which should not be overstated, and that is there are a lot of potential external factors which the Bank of England has no control about, whether it's conflict in the Red Sea or anything like that. All of these could send inflation soaring up again, and so put the whole plan into a potential tailspin. So that's always worth bearing in mind. Now, what can you do in order to prepare your finances for this? Well, I think there are a few key things that you can be looking at. The first is, if you have debt, to refinance it where possible. If you've got a bit of a credit card balance, maybe look at a 0% balance transfer credit card, maybe look at a unsecured personal loan. Anything you can do to try and lock in those payments and transfer liabilities that you've got sitting on your own account is going to be worth doing, particularly if interest rates are going to stay higher for longer. Second, having a good sized emergency fund is always going to be worthwhile doing, even outside of higher interest rate environments. It just means that you don't necessarily have to go into debt if you have a big bill that you have to pay. You can just pull out of your emergency fund. That's what it's there for. And then finally, one of the few pieces of good news is make sure you're taking advantage of these higher interest rates. This is the first time, certainly, kind of in my, we'll call it economically active lifetime, where you can actually get a decent rate of return on a savings account. So if you've got spare cash, make sure you're earning interest on it. You might as well whilst it's here. So in this video we've talked about why it feels like interest rates aren't necessarily going to come down as quickly as initially expected, some of the factors that are going on behind the scenes and what's potentially driving that, and how you should be preparing your finances. Thanks very much for watching. If you've liked this video, please like and subscribe below. Peace.